So for those of you who don't know me, my name is Mitch Michigan, and I'm a partner at Blockchain Co-Investors. So you heard from Matthew, and you've heard throughout today that blockchain technology is a true horizontal innovation, and it's disrupting several industries and verticals, and you'll see there's many use cases today. However, blockchain is not a monolith as an investable asset class, and it actually has some unique characteristics, specifically tokens v equity that need to be taken into account, before you make an allocation decision. So that's what this content is about. We're going to outline what we believe are the 6 distinct investable asset classes within blockchain technology. And then we'll try to go over some of our own firm's best practices for accessing each of those categories. Again, as I mentioned, if you have any questions throughout the presentation, pop those in the Q&A box, and I'll try to get them answered at the end if there's any time permitting. We've said it a few times today, but just want to reiterate that this is not investment advice. Nothing should be construed as investment advice. For the avoidance of doubt, this is purely for educational purposes only. So why invest in blockchain? Well, our investment thesis, we believe, is quite simple. We were there in the early 1990s while the internet digitalized communications and content. But at the time, we did not digitalize finance nor commerce, and we actually did not have the technology for natively digital monies, commodities, nor assets. Matthew mentioned up front, but after the Bitcoin white paper in 2008, we actually saw that blockchain technology, which underpins Bitcoin, could actually upgrade the world's financial infrastructure, which would ultimately lead to natively digital commerce. So we thought the same thing that would happen to commerce and content would happen to finance. But because commerce is far larger than communications and content, we actually believe that this will be the largest ever value creation event. So to state it quite simply, we see blockchain as an infrastructure technology that will upgrade the world's financial system. And in a very short amount of time, just a little over 15 years since the Bitcoin white paper, investors have already started to take note of this asset class, right? So this is a 2023 survey by Institutional Investor. And you can see here that digital assets ranked as the 3rd most attractive asset class in terms of risk and return, just behind private equity and US equities. That's outstanding performance in such a short period of time for a completely novel asset class. New asset classes don't come around very often. When you break the numbers down and you look at institutions versus retail, you get similar results. So here is an Ernst & Young survey from last year. This was a survey of 250 C-suite level institutional investors, and they basically showed an overwhelming belief in digital assets and blockchain technology, and in particular, in tokenization, which kind of underpins the overhaul of the world's financial system. We've heard through 2 sessions already today on tokenization, how exciting that is. But retail and wealth management advisors are also taking note. So this is a Bitwise survey. We've had a few members from the Bitwise team on today, and they ran a survey that was published earlier this year. And essentially, wealth management advisors, they're seeking to increase or at least maintain their clients' assets to the space. So again, whether or not you look at it as institutions, wealth management, investors really are taking note. So what is all the fuss about? Why is everyone, so excited about this space? Well, we can start at the top. What is a blockchain? What can it do? Technically, a blockchain is a distributed, decentralized public ledger that exists across a network. And so most simply, I think you can think about it as a coordination mechanism across the internet. And that can be applied to a variety of use cases. But for financial products, which is the core to our thesis, this will allow basically assets, monies, and commodities to move seamlessly in a secure manner and instantly. But outside of finance, and you can see there we have those as the current use cases, mainly financial applications, there will likely be other use cases that permeate beyond finance in the coming years that range from things like digital identity to gaming to decentralized social media. Many of these projects are out there already iterating, but again, we see those as more future use cases, and we really see the core use cases of payment, store, and value. Asset tokenization is happening right now, and you see that in the news all the time. And underlying these use cases is a full technology stack, right? So this is very similar to other innovation waves we've seen, such as the internet. So blockchain is no different than the internet. There's actually a foundation layer upon which protocols and platforms are built. There's a transactional layer where digital assets are custody, held, transferred. And then on top of that, there's the application layer, right? So consumers and enterprises are actually going to interact with products, and they're going to have applications that face them that stand on top of this technology stack. And what's important to note is that there's a flourishing ecosystem in each of these technological areas. And what that means is that, you've seen many VCs already today, and you're going to see some of the top ones in the Asian continent in just a moment, but there's a wide investable universe within blockchain technology. Each of the, area of the technology stack has produced, unicorns, very large companies, and there's a lot of development happening in all those areas. So blockchain technology, again, very similar to other innovation waves that we've seen, like the internet, is a very kind of large use case and technology stack. But something that makes blockchain different, probably the key component, is the token component. And so we all know equity, right? Equity traditionally gives ownership and voting rights and is a fairly standardized security, right? Fairly standardized in certain jurisdictions, most notably Delaware LLC. Tokens are not so similarly defined. So tokens are, in technical terms, a unit of account within a public ledger of a blockchain. So basically, you can think of it most simply with the Bitcoin blockchain, right? The ledger will tell you how many blockchain each kind of person in the network has. You have 1, you have 0, and if I transfer it, updates this to 0, updates that to 1. But on top of that, newer blockchains and new innovation in the space have allowed for smart contract blockchains. That means that tokens are programmatic. So that means that tokens can have many, many different roles within a protocol or ecosystem. That means that tokens can actually be securities, right? You've heard from today that, certain firms such as Securitize and Archax are tokenizing actually securities. So a token could represent equity, it could represent a credit fund, it could represent a money market. But a token can also represent completely novel use cases that are not so easy to understand or map onto the traditional kind of definitions, and there's limited standardization. You can see here how we think about some of the applications of tokens. This is not all encompassing, but it's a pretty good frame of reference for what's happening in the ecosystem. The first 4 are actually really intuitive as they pertain to products we have in the traditional financial world. We're basically mapping traditional financial products or concepts on chain onto a blockchain. For instance, a CBDC is a digital version, what it stands for central bank digital currency. It's basically a government-sponsored token that is equivalent to a fiat currency, right? So the government maintains the ledger itself. Outside of the public sphere, you have similar iterations of digital money, where you've seen a very large number of successful stablecoin projects, more than 150 billion in outstanding AUM in terms of dollar stablecoins, that basically peg a token to a dollar, but instead of being managed by a government, it's managed by a private institution. Crypto assets are essentially forms of digital money that are seeking to do something very similar, but are not maintained by a central authority, neither public nor private. So you could put Bitcoin into this bucket, right? Bitcoin seeks to be a form of money, perhaps not for payments, but a store of value at the very least. The original concept of Bitcoin was a peer-to-peer version of electronic cash. However, there's no central authority in the center of Bitcoin, right? There's neither a private nor public issuer, and it's rather maintained by this decentralized and distributed network, that we call blockchain. Finally, other asset-backed tokens you can see there are basically tokens that represent some asset or commodity on chain. We've seen, for instance, tokens representing gold, or you heard today, Securitize has done several LP stakes in funds, credit funds. And basically, the benefit of these tokens, you can think about is that you get a traditional financial product that you understand, regulatory regime, but that's going to be layered on top of a blockchain infrastructure, which means that these tokens are going to be secured by distributed networks, move rapidly, move cheaply. The next 4 tokens are relatively new ideas that are not so easy to kind of map onto traditional products. So the first would be protocol tokens, and these are tokens that incentivize and reward participants in a protocol. For instance, a project may give some of its early developers tokens for contributing to the open source code base. Later on, these tokens may become useful in the ecosystem, pay for sort of issuance, gas fees, and basically you can reward participants for contributing to that code. Utility tokens are tokens, based on its name, that give you utility. So basically the users in the network will need this token to do something, either obtain it, spend it, hold it, and to utilize the protocol. A good instance of this is decentralized storage protocols like Filecoin or Arweave. You may have a decentralized network of free hardware space that you can access, but you can only access with a certain token, right? And so that token, where they give you that utility, gives you access to storage. DeFi platforms or decentralized finance platforms and protocols, they may issue tokens that do a variety of things, but such as, govern the network, determine which financial products are involved in the decentralized financial network, and also reward key participants, the key liquidity providers to, a money market or loan pool, for instance. And then finally, NFTs, or non-fungible tokens, are very, very interesting and will likely have many use cases. And basically, they're tokens that are one of one, meaning that they're not fungible, right? And they're going to be tied to a specific digital item. Most famously, these are used for digital art or collectibles, but the use cases go far beyond this, and these will certainly play a large role in the financial ecosystem in the future. And so what's important to understand in blockchain is how equity and tokens are both similar and different. And so what's on the screen now is sort of your standardized life cycle for a high growth operating company, a technology company with high gross margins, the life cycle. And for blockchain equity, it really does follow kind of that traditional technology kind of mental model of how a company progresses. At the outset, you have a company working on its product and engineering and preparing for its go-to-market. Here a company is going to raise from friends and family, angel investors, seed funds. And the companies, if it's a high growth technology company, typically it's not making any money. It's actually going to be burning cash, right? They're building that product. They don't have anything launched. Ultimately, if it's successful, the project will launch its product, hopefully start to make revenue, and move on its way to cash flow positive. Somewhere along this journey, you'll start to see professional venture firms start making investments depending where they like to play in that journey cycle. And later in that journey, you'll also see growth funds start to invest and late stage funds start to invest, as there is a, demonstrated product market fit and things like this. Finally, for the very successful projects, the top 10% of projects are going to be an exit event, probably an M&A sale. And for the very successful projects, the unicorns, there will be an IPO liquidity event via the public markets. Tokenized projects follow a similar path, but with key differences. And you can see here, what we put on the screen gives you some figures to give you a sense of how the mechanics and fundamentals work. At the early stage, you have a core group of developers that want to launch a project that will have a token. The structure can be quite different than in an equity round, right? You might have a foundation or a nonprofit that manages the token, or you could actually have an operating company being the investment vehicle, right? You could have a traditional company whose kind of purpose is to contribute code to the code base and will obtain some tokens and that's where the value will be held. Just like with equity, the team's going to go through various rounds of investments with professional investors. But unlike equity, you're almost always going to see some portion of the kind of token supply allocated to the ecosystem or community. And this can range from anywhere from 30 to 50 to 60%. But you certainly now, it's very much market standard for a portion of that token supply, not only to go to investors and the team, but also go to the community, right? The participants in the network again. And you can see why, based on our token taxonomy, that a lot of the purpose of these tokens is actually to incentivize use of the network and get past the cold start problem. Just like with a successful equity company, and even more so, really the route to a successful tokenized project is a going public event. And in tokenized projects, this is called the TGE, or the token generation event. And this signifies when the token goes live and the users of the network can access the token. And it's often timed with a listing on exchanges such as a Coinbase or a Kraken. But of course, you can always access a token natively because they are permissionless networks. So again, you can see here, tokens, it's similar to equity. There are some differences. You're going to have vesting, you're going to have traditional professional investor rounds often, normally valuation step-ups in each round. But there are some key differences, right? The only path out is a liquidity event, a public listing, and the community is going to get a large allocation of these tokens. And this combination of tokens and equity, basically means, in our view, that blockchain investing has 6 distinct asset classes. And the way we think about it is we bifurcate between public and private, and then equity and tokens. So on the private side, we'll also distinguish between early and then mid and late stage because of the characteristics that are different of those companies, right? Early stage companies almost always burning lots of cash, whereas mid and late stage, you're going to be much more developed, maybe product market fit on your way to cash flow positive. And so how do you access each of these asset classes? You can see on the screen here, we've laid out the ways we think about it. And often they're basically equivalent for tokens and equity, but later on they're not. So at the early stage, you have direct investments, right? Your direct holdings. These are very difficult to access for the average person unless you're extremely well networked within technology circles. basically you're an angel investor. And again, in order to make the math work on this, you're going to have to be making 30, 40, 50 angel investments because such a high portion of these investments are going to fail. You also have early stage venture funds and early stage token funds. Many blockchain venture firms are focused on either both tokens and equity, or will kind of narrow in on one. Again, you heard from 1KX, they're 100% focused on tokens. You heard from Castle Island, they're mainly focused on blockchain equity, so you can be successful with both routes. And again, there are a number of firms that focus on both, like Greenfield One, who you heard from. Finally, at the early stage, if you want a diversified basket of both funds, you have early stage venture fund of funds like blockchain co-investors. This is what we do. So we allocate to, call it 20-ish funds in each one of our fund of funds at the early stage, both tokens and equity. At the mid and late stage, you also have a similar path for accessing tokens and equity. You're going to be able to do direct investments where, again, you can purchase equity directly if you're well networked, or you can purchase tokens directly from a team, project, or foundation. You'll start to see some secondaries here where you can buy equity from founding team members or early investors. And then you're also going to have funds dedicated to this. You're going to have mid-stage growth, late-stage funds that are focused on this asset class. These funds, the professional funds at this stage will tend to be more focused on the equity side than on the tokens. And that's just because that's what they're used to seeing. You haven't seen as many professional firms come into this yet. You see lots of kind of crossover funds trying to play on the equity side. And you'll also have some crossover from those early stage venture firms. These funds might hold a portion of their capital in reserve to follow on into winners from their early stage portfolio. And then finally, you have public equity and public tokens. We've heard today from Coinbase and Bitwise and a number of others. And those firms give you access, and there's a substantial difference here from now on the public side in terms of equity and tokens. So for the public to access an equity investment, company has to have a public listing, obviously. And what that means in most jurisdictions is that you're going to have a prospectus document approved by a regulatory agency like the SEC in the US. And these public listings will typically happen via IPO SPAC or direct listing. And then after they're public, you're going to have some number of ETFs that try to give you a basket of all the public companies that have significant blockchain exposure. But today there's something only like 20 pure play public blockchain companies. We think that number is going to go up substantially in the next 3 to 5 years. And most of those public companies are actually Bitcoin mining firms. On the token side, again, once that project has its token generation event, which is really the only path to liquidity for most of these investments, anyone can access the token. So you might be able to purchase the token from an exchange like a Coinbase or a Kraken, but you can always simply download a wallet native to that protocol and self-custody the asset. So these networks are permissionless, meaning that anyone can access and use the network. There are no gatekeepers for the most part of accessing these tokens. We also now have seen, really over the last 3 to 5 years, ETFs launched globally that track these tokens. They basically give you a wrapper that allow you to use an equity-like instrument to get that exposure to the tokens. These have existed, in several jurisdictions for years. Notably in the US, the Bitcoin ETFs were approved in January, and those have been some of the most successful ETFs, ever to launch anywhere globally. And then finally, public liquid token strategies. There are, of course, hedge funds that focus specifically on this strategy, and those tokens will try to trade and use arbitrage opportunities, leveraged opportunities, derivatives to get a return in a token strategy as well. And so where do we play in this, and why do we focus on certain areas? Well, for us, we specifically focus on the early stage for both crypto assets and blockchain equity, as well as the mid stage primarily for equity. So very central to what we do is our fund of funds. We're investors in more than 40 early stage blockchain focused funds that are all native crypto blockchain funds. And we think that gives us unique access to both tokens and equity at the early stage. We think the returns are highest at the early stage, and that's where we want to play. But we also want to have a diversified basket, right? We know that the power law applies in the situation. So we want to have a diversified basket at that early stage, get access to the whole ecosystem, the whole technological innovation. And that means that wherever the winners are, we'll capture some of that value. It also then informs our strategy for our allocation to our direct funds for both the early stage and mid stage, right? We want to be co-investing with companies coming out of that fund of funds. And so what are some of our lessons learned? What are some of our advice for investing in the space. Well, we'll go general and then we'll talk about fund and then talk about direct investings. But we took several lessons from the internet era of investing, right? So specifically, we know that we want to invest ahead of powerful tailwinds. We saw that the internet was the largest value creation event ever, and we think that a similar disruption is coming to finance and commerce. So we want to position our capital ahead of that shift, right? We want to invest before that shift happens. That's why we've set up the fund the way we have. Also, and probably equally as important, is that we want to be early on the cap table. That's where the returns are the highest, right? So we think that we want to be investing when valuations are very low, when access is very difficult to get, because access is essential. The best investors are going to consistently source the top deals, so we want to be co-investing with them. That also allows us to then access information asymmetries. That's what we think leads to consistent overperformance over time, right? So we want to be investing in that fund of funds with the top investors. And then, when we do invest directly out of either their direct funds or sometimes we set up SPVs, we actually want to co-invest with those top investors as well. So we know that manager persistence in early stage venture is exceptionally high. What that means is that the top fund managers, top quartile managers, tend to remain in the top quartile in their next fund. So we know that those top managers are going to source the top deals. And so if we're investing directly, we know that we want to be co-investing with top managers. That's a signal that we're going to be getting top access. We mentioned it already, but diversification we think is key at the early stage, right? It's a high risk, high return asset class, and early stage venture follows power law returns, meaning that you need to be invested in a number of companies to make sure you're getting access to those big winners that are going to basically drive all the superior returns. If you miss those big winners, it's a very difficult asset class. So you have to be in the big winners at the early stage venture, even more so in blockchain technology investing. And then finally, invest through the downturn. So when markets get bad, you don't stop investing. You have to continue investing. It's critical to invest when valuations are low and sell when they are high. And that's what we've sought to do with our firm through many market cycles. So in terms of actual advice for making your own fund investments or making direct investments, we can start with the fund, but we actually believe we're some of the most prolific blockchain fund investors in the world, with more than 40 investments made across 30 fund managers. We have a disciplined approach and process, and each manager must pass our filters and coverage screening before moving even into due diligence. And to give you some specifics, we look at manager reputation, right? Are they well-known in the space? What do other founders, builders, LPs, managers say about this team? What's their strategy? Does it make sense based on their background? Are they really going to be able to source the deals that they tell us? What's the size of the fund, right? Are they too small? Are they going to be able to get in top deals? Are they too big? Are they going to be, once you get big enough, how many 250K seed checks can you write, right? You have to have a relatively well-sized fund to get the access that we're looking for. Past performance, of course. Do they have a track record of investing in top deals? And then suitability, how do we feel about their character and brand and positioning in our fund? Once this screen is met, we then make sure that our managers give us the right coverage, right? And so because we're building a diversified basket, we are a fund of funds. Essentially, we want to make sure that we're covering geographies, investment themes adequately, right? So typically we aim for 50% to the US, 25% to Europe, 25% to Asia. I mean, I think this conference is a perfect example of why we do that. We spent the morning with the Europeans. That's where the center of the ecosystem was for 5 years. Then it shifted to the US, but Asia's always played a great component and may be even taking a lot of that market share. So you want to have allocation to all those geographies. Same thing goes for investment themes. We have funds that are focused on Bitcoin, on Ethereum, on infrastructure, on gaming. So we want to make sure we're not narrowing on just one subset of blockchain, one part of the technology stack, but really covering everything and making sure that we're going to be skewed in all of those sectors to the early stage. The last thing I would say, we don't need to go through all of this, but just kind of a key lesson learned and something that we believe strongly in is that when you're selecting a fund manager in this space, we really think you should focus on specialist managers, meaning that they're specific to blockchain, crypto, digital assets. And this space is extremely complicated. And for that reason, we don't put generalist technology firms in our fund of funds. We think that if you look at a lot of what happened over the last 2 years, a lot of the big issues that firms had, a lot of those companies were backed by kind of generalist funds that had crossed over when the market was hot and valuations were high. And a lot of the crypto native funds, crypto native GPs actually did not invest in some of those kind of notorious projects. And so we think it's really important that you're accessing top investors with specific knowledge in the space. When we're doing direct investments, we also have some core fundamentals we're happy to share. For us, first and foremost, the investment must be at the forefront of the digitalization of assets, monies, and commodities, right? So we think that's the tectonic shift happening. So we want to position our capital in front of that shift. So it has to be thematically aligned to our thesis. As I mentioned, when we invest, we want to know that there are other top investors investing. That's a very large market signal. That's what the data says. You need to co-invest with the top investors. Once they're through those two screens, well, then, of course, the company or project must have a compelling product, strong management team, an attractive return profile. And then also something to double click on is that last bucket there, which is identifiable path to liquidity. This is very important in this space. A lot of firms have, broken some regulatory glass, and that may prohibit their ability to sell to certain corporates or even conduct an IPO in certain jurisdictions. And so when you're making a direct investment, you really need to think about, how am I going to exit this position? Can this IPO in the US or Europe? If not, where can it IPO? Who's a natural buyer? That's something that's fairly specific to this ecosystem, given the regulatory uncertainty that overhangs it. And what about the returns? How does this asset class compare? Well, on the screen now, you can see a public comparison versus other asset classes. You can see the last quarter, last year, and the 3-year and 5-year returns. I'll just let you look at this for a minute. You can basically see that, the returns speak for themselves. So as investors and allocators of ourselves, we see these numbers, and it's hard to ignore, right? I think you have to take notice of this and also see that this is not just a flash in the pan, a 1-year thing. Where you may have been following in the media and thought that digital assets has had a really bad few years. You can see that if you invested 5 years ago, your returns would have been, absolutely exceptional. And another way to think about this is actually looking at how Bitcoin stacks up versus other asset classes. Now, we're early stage focused investors, but Bitcoin obviously is the premier asset in the space. Is a bit like the S&P 500 for digital assets. And if you stack Bitcoin up versus other asset classes over the last 13 years, you can see that Bitcoin has been the top performing asset class in 10 of those years. Now, it's been the worst performing asset class in 3 of those years, so there's certainly some volatility there as well. But I think when you see this again, it just lets you know that this is not just a flash in the pan. This is not just a 1, 2, or 3-year event even. It's something that's been persistent over the course of a decade. And so when we look at this, we think it's easy to see why Larry Fink, the founder of BlackRock, is basically pivoting his firm to focus on blockchain technology, whether it be the ETF or tokenized funds or tokenization of financial products. Right? You can imagine he's been tracking this space for some time and seen that this is really a persistent and high return asset class that is here to stay. So this wraps up the content for this section, the opening section for the Asia portion of BlockTalk. Again, for the 300 investors who are joining us over the course of today from either Europe, US, or Asia, we think it's really important before you invest in any asset class to understand its characteristics. We've laid out how we think about blockchain technology and how we distinguish between early, mid, late, and public stages, as well as between tokens and equity. And so we hope that this has created a frame of reference for those of you considering allocating capital to the space. So with that, I think we're going to move to our next panel. I think Matthew will hop on and rejoin us to go over the results of the previous poll. We have a very exciting panel for you all here. And there Matthew is.